So the market volatility is continuing with wild swings up and down. It might be scary to see your portfolio going down, or maybe you are just like me. You get excited and see the market volatility as an opportunity. Maybe you want to just lean into some dividend giants, but at a fair price. Welcome to the channel. Happy Easter. I'm the Swedish dividend investor, and today I want to talk about 3 American companies I'm keeping my eye on during periods of increased volatility. Why do I get excited? Well, since when the price falls, the dividend yield increases. And if we invest into safer and stronger companies, the risk of a dividend cut isn't as high. So we are looking for quality companies with strong business models and strong balance sheets to weather the storm, but we also don't want to overpay for that quality. It has to make sense. So today we are going to be using my intrinsic value calculator to value the companies so we can know at what price we start to buy them. If you're new to the channel, I've shown this in some of my videos. Basically, I make assumptions about growth, and using math we land at a fair price to pay for the company so we don't overpay. Even if these 3 companies are very high quality, they aren't immune to market crashes, but typically they don't suffer as much as, well, other stocks. Nvidia. Let's dive right in. The first company is PepsiCo. I don't know if they need any introduction. Salty snacks and non-alcoholic beverages. Their dividend stats are pretty amazing, with the yield hovering around 3.8% currently. 52 consecutive years of dividend hikes, and a short to long-term growth of that dividend between 7 and 8%. I used to own Pepsi, but just a small amount, and I sold them at around $175. But I would gladly buy Pepsi if the yield is higher. So let's just take a quick glance at their balance sheet. If you want a deeper dive into PepsiCo, check out my full analysis video. I'm just going to speedrun this one. Revenue growing, net income slowly growing, but the debt, especially the short-term debt, has gone up. The payout ratio is also a bit high, both for the free cash flow and earnings. Heading over to the dividend valuation. I've entered their dividend of $5.42. I've gone with the growth number we have from Seeking Alpha. 10% discount rate, so a nice 10% annual return. Normal case 7% growth and a terminal multiple of 27, so a 3.7% yield at year 10. And we get a present value of $150.43. Best case 8% growth and a terminal multiple of 30. So 3.33% yield at year 10, giving us a present value of $174.38. For the worst case, I've used 5% growth and a terminal multiple of 22, so 4.54% yield, giving us a present value of $113.66. Blending them together with a 60% probability for the normal case and 20% each for best and worst case, we land at $147.86. And if we want a 10% margin of safety, we would need to buy them at $133.08. So, a buy right now, without a margin of safety. I would personally wait for a plus 4% yield. But there you go with the first one. Moving on with the second company. Coca-Cola. Ah yes, Coca-Cola, the cornerstone of many dividend investor portfolios. Also in the non-alcoholic beverages business. Maybe even more brand recognition than Pepsi. Here we have a consecutive hike streak of 62 years. Wow. The growth here is a bit lower than Pepsi, sitting at 4 to 5% CAGR for 3 to 10 years, and the yield is a measly 2.8 to 2.9%. Maybe the glorious days for Coke are in the past. Let's take a look at their numbers. Alright, let's start with their charts here. We can see the revenue ticking higher, along with some but slow net income growth. The free cash flow is all over the place. The only steady growth is in dividends and capex. The long-term debt is growing after a downward trend for the last 4 years and now exceeding the 2020 levels. Something to keep in mind. If we go over to their balance sheet, we can see their shares outstanding is flat. They increased and then decreased during the last 5-year period, but they are basically flat, so no real buyback effect here. If we take a look at their payout ratio, it's a bit high. Earnings payout is 78.63% and the free cash flow payout for the last year is 176%. And even if we use a much smoother 5-year average free cash flow payout, that ratio is 95%. Something to keep in mind, I would say. I'm just going to do a dividend valuation today, so let's head on over to the valuation page. I enter their dividend and I've gone with a 10% discount rate for every case, so we want a 10% return. Normal case growth of 4%. Terminal multiple of 25, so that's a yield of 4% at year 10. Present value of $43.17. Best case 5% growth and a terminal multiple of 30, so a 3.33% yield at year 10, giving us a present value of $52.54. Worst case 3% growth and a terminal multiple of 20, so a 5% yield at year 10. Not very possible, but I could see it happen, giving us a present value of $34.99. Let's go with a probability of 60% for normal, 20 for best and worst case, and we land at a fair price of $43.41. And with a 10% margin of safety, we would need to buy at $39.06. Just looking at their 5-year chart for their dividend yield at Seeking Alpha, we can see in May of 2020 their yield was 3.75%. Maybe you think I'm a bit unfair with the terminal multiple, but even changing the cases to 30, 35 and 25, the price still comes in under $50. Changing the discount rate to 5%, so a 5% annual return, only then, based on the growth we assumed, will they be fairly valued at today's price. However, if they get down below $50, and that's not impossible, I would seriously be considering buying them. Moving on to the last one. Procter & Gamble. Good old Procter & Gamble. Consumer defensive goods such as toilet paper, dish soap, shaving equipment among many other products. Classic name in dividend portfolios. The only problem is they rarely get down to a reasonable price. So let's check Seeking Alpha. Their dividend yield is sitting at roughly 2.5%. Looking at the dividend growth, it is somewhere between 4.5% and 6% for the last 10 years. But what is amazing is their dividend track record. 68 years of consecutive dividend hikes. Absolutely mental. Their yield the latest 5 years got as high as 2.9%, so not even 3%. But I'm sure they got above 3% during the 2020 crash. So let's check some balance sheets numbers and do some valuation. Now, like the last two companies, we can see a steady revenue increase and a small increase of net income year over year. Somewhat stable cash flow, and also the debt is going just a tad bit higher. Their shares outstanding is going down, so we can see the buybacks doing its thing. What I want to highlight here is their dividend payout ratio. Looking at their cash flow, look at that. That is some relatively safe numbers. The highest we got was 65.28%. Very nice to see. The price to cash flow is also more attractive than Coke's, sitting at 27 versus 35. And those are the 5-year average cash flow to smooth things out. Enough talking. Let's go ahead and do the valuation. Same as the others, using a 10% discount rate and the historical growth numbers. Normal case 5% growth and a terminal multiple of 32, so a 3.12% dividend yield at year 10. giving us a present value of $114. Best case, 6% growth, a multiple of 38, so a yield of 2.63%, giving us a present value of $139.40. And finally, for the worst case, 4% growth and a multiple of 30, so a 3.33% yield. We land at $101.11. Mixing them together with a 60% probability for normal case and 20% each for best and worst case, we land at $116.50, and using a 10% margin of safety, we land at $104.85. Ouch. So pretty overvalued, and they need to fall a lot. It could happen. So, changing the discount rate to 5%, we get in line with today's price. So that's not very good. Of all the three stocks, with a long range hole puncher to my head, I would go with Pepsi all day, maybe even without the threat of getting a hole in my head. Remember, I use conservative numbers and estimations, so your calculation may differ. Maybe you know something I don't. Maybe you believe Coke or PG will grow that dividend even faster. So the calculations are based on my assumptions. The good thing is, no one is forcing you to buy anything. You could find better opportunities or just sit on your hands, waiting for a better price. Anyway, what about you? Are you an owner of any of these companies? Let me know in the comment section down below. But that's it for this one. Remember to leave a like if you liked the video, subscribe for more dividend investing content, and tickle the algorithm with a comment. I'm the Swedish Dividend Investor, and I will see you in the next one. Stay smart, stay patient, and keep stacking those dividends. Ha det gött!